Now, specifically, we work in the cap and trade, cap, trade, and reduce, some people call it, carbon market. So how does this cap and trade emission trading system work? Well, the first thing to understand is that it's a government policy that's meant to cap and reduce emissions. That's the objective of the policy. And for instance, I'll take you through using Europe. Europe is the largest carbon market, covering 28 countries and 3 external countries in Europe. And really any entity that emits more than 25,000 tons of CO2 per year, by law, you're in the program. That means every year you're audited and you must submit carbon allowance certificates each year that match your emissions. If you don't, there are heavy penalties. So any entity is included. So in Europe, there's about 13,000 of the biggest companies, the big emitters, the big polluters that are included, and that covers about half of all the emissions in Europe. The total emissions across Europe are capped at about 1.6 billion tons per year. And every year that cap comes down by about 2% a year. So this gives us the environmental certainty that we want. We want emissions. We want to know that emissions are going to be capped and come down. And the allowances are auctioned on a daily basis in Europe, or if you have a vulnerable business, you are freely allocated, but the amount you're allocated every year drops by that 2%. Each allowance, whether you buy it at auction or you're allocated it, it allows you to emit 1 ton of CO2, and every year you're audited, and you must submit permits at the end of the year that match your emissions. There's also the liquid trading, so cap and trade, and there's trading between the participants, and that sets a price for carbon. And setting a price for carbon is very, very important because it sends a strong price signal to the market. Now, different companies are looking at low carbon options, and they will each have a different price at which it makes sense to switch. So by having a market price, it allows companies to plan, to hedge their carbon emissions into the future, but all the time we know there's a cap, and every year the cap is being lowered, so emissions have to come down. By trading the allowances between the parties, they quickly learn who has the lowest cost of stopping emitting carbon dioxide. And as soon as the carbon price hits that level, that company stops emitting. When the carbon price rises to a higher price, then another whole set of companies, it makes sense they can now switch to another industrial process that emits less or no carbon. So you have this key objective of this policy is not only the environmental objective of capping and reducing, but we want to do it at the lowest cost. And that is what cap and trade delivers. So I hope you're getting the economic elegance of this, of how we harness this market externality, which is what carbon dioxide emissions are. They're external to the economy. They don't have a specific price in most countries, but they do have a definite damage to our economies. So this cap and trade addresses that and allows it to be priced. The other really interesting thing is a liquid carbon price and a liquid carbon market that fosters huge innovation among entrepreneurs, scientists. It gives a direct incentive to venture capitalists to back people with low carbon technology because they can monetize that technology. Again, we live in a market-based economy. So this is the other, I think, beauty of a cap and trade in a liquid carbon market. It fosters innovation and allows people to develop interesting, innovative technology for low carbon. One last point is that I want to point out that in most cap and trade markets, the majority of the revenue from auctioning these carbon allowances every year, which is quite significant, is reinvested in green initiatives, low carbon technology.